All right, so nice to meet you, everyone. I'm Heloise. I'm the analyst at Secocha Ventures. I'm dialing in from Miami. I'm super excited to introduce Alex today, who works for NEA and is dialing in from the DMV area, if I'm not mistaken. So today he'll be going over financial modeling. And the presentation is broken down into 3 different segments. We'll take a moment to pause after each segment to take questions. Since there's going to be a lot of people on the call today, Abhinaya and I will be moderating. So if you have any questions, please drop them into the chat. And then Abhinaya and I will read them to Alex at the appropriate time. Some things to keep in mind today. This session is being recorded. So there's anything that Alex says that you want to review later, you'll definitely have the opportunity to do so. We'll share the link in the channel afterwards. And we will also be sharing the deck that Alex will be presenting. So since this is a financial modeling presentation, there's some numbers in there that you might want to look at afterwards. You'll have the opportunity to do so. So don't feel like you have to screenshot everything. We'll share that with you. Yeah, and so with that, I'll let Alex introduce himself.
Thank you, Heloise. I appreciate the warm welcome. I'm excited to be here with everyone today. This is a topic I'm personally passionate about and have spent a fair share of time thinking about. So I'm excited to share some of those thoughts with you all. Quick background on me. So my name's Alex Sharata. I'm an investor at New Enterprise Associates in their SF office. I focus broadly on consumer and enterprise investments. And quickly on NEA, we're a 40-year-old venture firm with footprints on both coasts. And we are sector and stage agnostic. So we're looking at anything from seed all the way to growth and pretty much everything under the sun in terms of sector that will roll up into tech. Previously, before NEA, I was an investor at a firm called Vista Equity Partners, which is a software-focused private equity firm. And over there, I built my fair share of models, mainly focusing on much later stage, more mature software businesses and subscription-based businesses. So I can share some learnings from my time there as well. I'm having trouble screen sharing. Eloise, I don't know if I sent you guys the latest presentation if you guys want to screen share.
Let me try real quick.
Cool. And we can kind of get started without the slides. But so I personally didn't study business or finance while I was in college, and so I'm mostly self-taught. What I found, as I was kind of going through the ropes of learning how to model, is that a lot of websites and online resources never really helped me piece together how all these metrics and ratios that you read about, how they fit together in the context of a model. So you might read an article or a tutorial on how to calculate, SaaS magic number, or LTV to CAC, or the quick ratio. But there aren't really any articles that help you, again, kind of understand what all those metrics mean in the context of an income statement or a 3-statement model. So hopefully we can demystify some of that today. Still having some technical difficulties with screen sharing, but I'm trying to think of a workaround.
Sorry about that, guys.
Yeah, we'll send around the deck. Everyone can just follow along on your own. So
I'll shoot an email to everyone with the deck right now as we get sorted out with the screen sharing settings.
Sure. But anyways, the deck is pretty dense. It has a lot of words and graphics packed in a very few slides. So given we only have an hour, we're not going to be able to hit on everything. And so you guys should definitely use that deck as a reference as you kind of embark on your own modeling journeys and reference it Okay, let's see. Claim host in the panel. I need all my Zoom experts right now to help us figure this out. Okay.
Oh, wait, Alex, what are you seeing? Like why?
It says host disabled screen sharing.
And who's the host? Heloise?
Yeah, so the host is Suchen. So we're pinging her right now. Sorry guys. But I'll share it in the channel right now so you guys can follow along.
Cool. Hopefully you guys get that soon. Apparently there's a way to claim host. I'm looking for it.
You can do it from the participant panel. If you open the participants and then there's like an invite, mute me, and a ... and it says claim host.
Oh, cool. Okay. Oh, we need a host key. I don't know if this is going to work, but yeah, everyone can just follow along on their own. But
I just shared it in the channel on Women in VC if everyone wants to open it and follow along.
Cool. I'll give folks a couple seconds to pop it open. But again, the deck should just be thought of as a reference tool. We're not gonna, each topic in there can, merits its own 1 hour discussion. So we're gonna kind of just go over all those topics and provide sort of commentary so that everyone just kind of is definitionally aware of what the topics mean. And then on your own, if you want to dive deeper into any one of those rabbit holes, you can. So cool. Hopefully most people have the deck open by now. I see some nods. Okay. Great. Well, I'm looking at page 2. So quickly on topics. Again, we bucketed the presentation into 3 sections. And the first section, we're just going to do a quick intro to modeling, sort of what to look for, how to approach modeling at an early stage, and when you might have little to no data on a company. And then we might also look at a business that's later stage, where you have like a data room or a ton of files that management sends over, and you got to figure out how to make sense of all those files. And so we'll hit on all of that hopefully. I'm going to kind of go through the first section quickly, and so we can get to all the good stuff, mainly early stage specific modeling techniques, and then hopefully some later stage modeling techniques. So I'm on page 3. What's a financial model? The long and short of it is, the way I like to think about every sort of venture-backed business is boiling it down to easy principles. Every business you can kind of think of as people, intellectual property, and customers. You have engineers building the product, and salespeople selling that product, customers that pay you revenue, and that revenue obviously helps cover some of your costs and as a business. And then you might use some VC money to help you cover sort of the rest of your expenses while you're still unprofitable or burning cash, right? So most of us have seen that. And so the modeling concepts we're going to discuss kind of center around representing those 3 pieces: people, product, customers, in Excel. And along the way, we'll hit on some helpful operating metrics that you can infer from a model and use to forecast your projections. Cool. Awesome. So how are models used? So this Venn diagram highlights essentially 2 main use cases for a model. Obviously, I assume most of us on this call are investors. So we're going to be sort of the personas in the left-hand part of the Venn diagram that are using a model as part of a toolkit, or part of our investment toolkit. It's just one tool of many that we can use to kind of best represent a high-level abstracted view of the operations of a business, and B, it helps us sort of lay out all the variables that contribute to revenue and core profitability, and how changes to those variables and operating assumptions can impact our returns as a VC. But models can be used by a ton of different personas: CFOs, FP&A teams, lenders, equity research analysts, what have you. And so the focus isn't going to be too granular, like how some of those other personas might use models. But again, we're going to focus sort of how you can add a financial model into your toolkit as an investor. So quickly, I'm on slide 5, modeling and Excel best practices. I won't spend too much time here. As I said, you guys all have this. But this page is a helpful reference that just kind of has some modeling Excel best practices that I've seen sort of applied over the years. At a high level, every model should be 3 things: realistic, flexible, and easy to audit, meaning anyone should be able to open up your Excel and for the most part follow it. The main thing here is just making sure that whatever work you do in Excel is, again, just really easy to read and easy to follow. All your numbers could be right, and you could be very thoughtful in terms of how you use those numbers to tell the company's story. But if the presentation or the formatting is off and it's hard to read, then it muddles the story that you're trying to tell. So I'll pause there for a couple minutes. If there's any questions, thoughts, is hopefully most of this folks have a baseline understanding of, but I'll pause just in case anyone wants to spit out any questions. If not, we can move into the next sections.
Looks like there are no questions.
Cool. Let's keep moving along. Awesome. Page 6, early stage modeling. So again, when looking at an early stage business, typically pre-seed through Series A, there's oftentimes very little data, or the business, might be just a little more mature than Series A, but they maybe didn't give you any data yet. And so you might be trying to form sort of an outside-in view of how big this business could get. And so the modeling concepts we're going to talk about here kind of apply to those 2 scenarios. Really, really young company with no history of operations, with no data, or maybe, a slightly bigger company that has some revenue, has some employees, but they just haven't shared any, key documents or files with you as part of their process just yet. So, you're trying to just get a sense for an outside-in view. So that being said, there's really 2 ways to think about modeling. You've probably heard these terms before: top down and bottoms up. Simply put, top down models sort of start with the macro bird's eye view of an entire market, and then you work your way down from there. While bottoms up forecasts really begin with the individual business, and then you kind of expand upwards from there. We'll get into some examples. But for the sake of modeling really early stage businesses, we'll focus on top down. Again, most top down models, you'll start by assessing the market as a whole. So first, we need to determine the current market size available for the business that we're evaluating. And then we can factor in relevant sales trends, market segment trends, et cetera, in order to estimate how much of the market will buy a company's products or services. So for example, if you, did some really great market sizing analysis, and hopefully some of you have maybe thought of, how to calculate TAM for a particular market, which stands for total addressable market, essentially all the dollars out there that are available in the market. And then, maybe you want to model out the company's revenue. You can take your TAM analysis, which gives you the full dollar size of the market opportunity, and you can multiply that by the market share that you think the company can realistically achieve. So I'm on page 8 now. Page 8 is just, I won't hit on it too much because I assume most everyone on this call has done some type of market diligence or market sizing analysis to kind of come up with a TAM when evaluating an investment. So this slide just kind of recaps some ways you might think about how to do a market sizing analysis. Yeah, so, core things here being, number one, you want to just identify important variables. The simple market sizing equation is, number of customers or users times revenue per user or customer, right? That's sort of at a high level, you really think about like the bare bones, what goes into a market, it's that, right? Then you can get a little bit more creative and add more detail based on sort of new findings or industry reports that you find online, or maybe you talk to some experts, right? And so maybe the company that you're looking at, maybe they sell to large Fortune 500 enterprise customers. And so you might want to focus, on just the Fortune 500. And maybe within that, they sell to certain verticals more than others. So you might want to segment your TAM, at a broad level by focusing on Fortune 500. And then at a sub level, maybe you focus by industry vertical, just as an example, right? And maybe your customers focus more down market and sell to SMB customers. And so they'll price their solutions differently, right? If they're selling up market versus down market. But anyways, let's look at a quick example of a hypothetical business. I just pulled these numbers together completely randomly that sells primarily down market. So they're selling to a long tail of SMB, small and medium-sized businesses. So I'm on page 9. This is just, an example of what a TAM analysis could look like. So here we see a pretty simple TAM build with 3 core sections. Again, this is all just hypothetical numbers. As you're orienting yourself around this page, and you go to review it kind of in your own time, any cell that's highlighted yellow is what's known as a driver or an input. So those cells are our assumptions that drive our projections forward. And so section 1, let's say maybe I was researching online and I found a research report that tells us how many customers exist, across the enterprise, mid-market, and SMB segments for the vertical we're interested in. And so, that's shown right there in those yellow cells. And then maybe, that research report also gives me some context as to how each of those segments is going to grow over time. And so then I can use those growth rates, and to sort of project out how many customers this market might realistically have, 5 to 8 years down the road. So that's what we do in section 1, just projecting out the number of customers. And then if we look at section 2, maybe we got some early pricing info from the company on how they price their product for each of these segments. And so that we can kind of bake into kind of thinking back to that TAM equation. We now know sort of number of customers that are available in the market. We now know sort of how our company that we're evaluating prices their solution. So we know the revenue per customer. And we can just do a simple, equation of take the number of customers we have times the pricing. And that ultimately gives us, what's in section 3, which is really just all the dollars available in this TAM, right? So super simple TAM. Hopefully this makes sense. I encourage you guys to review this on your own. There's no hard and fast rules for how to size a market. You can really get as detailed as you want. But just remember, try to base all of your projections in some hard data point versus you basing them off gut feelings. So cool. I'm shifting gears now to page 10, titled Sense Checking Management's Projections. So again, the 3 sections here, at the top, we have a view of the TAM, which we projected in the last page, right? So this is all the dollars available today, which is, if we look at it, it's almost a $4 billion TAM today. And we think that by 2027, based on those assumptions we discussed, it'll get to an $8.5 billion TAM, or just north of that. So now let's say, an entrepreneur or management team gave us some revenue projections of their own based on how much revenue they think they can generate in each segment. And let's say this business is, super early, like they were just founded, 6 months ago, a year ago, they maybe raised a pre-seed round or an angel round, and they're thinking about a seed or a series A. It's really tough. It's truly a shot in the dark trying to estimate how much revenue they're going to be able to get. But a quick sort of sense check we can do is if they provided us with some top line revenue projections, we can maybe drop those in to our TAM analysis. in order to essentially stack up and compare how much revenue they're going to be able to pull out of the market. So that's what we're showing in section 2. We drop in management's revenue projections, and it just so happened that in this hypothetical example, they segment revenue based on customer size. So they have large enterprise customer revenue, mid-market revenue, and then SMB revenue. And then, they project that the business is, if you look at 2027, they project the business is going to reach almost 500 million in revenue. So that's that $467 million line, right? That's pretty big, right? That's a $500 million revenue business, which there aren't too many out there of that size in this space. And so this hypothetical space that we're contemplating. And so, that's how management, that's the asymmetric risk that management thinks, the asymmetric return management thinks that they can get to, right? And then section 3 just kind of works backwards based on the pricing that management has shared with us to kind of get, divide revenue by the pricing to get into how many customers they're going to realistically have. And again, if you notice, this hypothetical business is selling way more to, small and medium-sized companies. And so that's where the majority of the revenue and the customers kind of sit. So if you look at that out year, that 2027, management thinks that, 360 out of 400 million out of $460 million is going to come from SMBs. So it's a really SMB focused business. Cool. Now I'm on page 11. Let's think about how we can kind of haircut management's projections. Because again, based on what we know about the space, based on our expert calls, and we've done some diligence ourselves, we know that the largest incumbent competitor is only at 100 million of revenue today. And so maybe, we talked to some experts and they also reaffirm that it's a really, really fragmented market, especially for companies that are going after the SMB segment. And maybe even some experts have quoted that there's no one player today that really has more than 1% share. So obviously today, if you look at our business, they're just under 2 million in revenue. So that's, an immaterial percentage of market share today, right? 2 million of revenue off a potentially $4 billion market, right? So they don't even have 1% of share. If you think back to their projections back on page 10, when they get the business to 460 million of revenue by 2027, that implies that they had almost 5% market share, right? Or just a little over 5% market share of the total dollars. So, triangulating that with some of the work we've done, what we've heard from experts, we know that might be a little bit aggressive, right? Because today there's no business that even the largest competitor in the space only has, maybe 1% market share or 100 million in revenue today, right? So we take all that into context, and now what we can do is we can haircut or discount management's projections based on what we believe to be a more accurate representation of the business. So hopefully we think that this business can get to 100 million in revenue, up from $1.8 million in revenue today, and follow a similar trajectory to the large incumbents in the space. So maybe that's our thesis of what we believe would be an awesome outcome, right? So we have that bogey in mind of 100 million in revenue, and it's validated by some data, some hard and soft data points. So let's work backwards from there. So again, I'm on page 11. If you look at section 2, you see the yellow cells are, again, those are all the driving cells. And we know some core truths about our hypothetical business, and we know the solution mainly targets SMB customers. So we know that a majority of the revenue should come from that segment, and that's what's highlighted in section 2. So then we kind of, again, we know our bogey of 100 million. This is where it becomes more of an art than a science. We kind of just work backwards and see what makes sense in terms of modeling out revenue by using market share, right? So now our revenue projections take our TAM times what we think is a more accurate representation of market share, and that equals revenue in each segment. So that's sort of what this page 11 is showing. And so you can see in the out years, we get the business to 100 million in revenue, which implies just north of 1% market share. So that kind of lines up again with our own work, our own beliefs, and some of the experts' beliefs, right? And so if you look at what percent haircut that is to management's projections, in the out years, that's nearly an 80% haircut, right? From management's $460 million in projected revenue. But if you look at 2020 and 2021, the haircut's much smaller, right? In 2020, the haircut's only 11%. So we're giving management nearly 90% credit for their projections because maybe we're already really deep into the year and they have really strong visibility on how they're going to sort of close out Q4. So we give them 90% credit for 2020. And then in 2021, maybe management shared some really helpful pipeline or sales funnel data, and we walked through it with them to get a sense for how realistic, or how much sort of pipeline they have and how close they are going to get to hitting their revenue targets. And so we felt really confident in management executing on their plan based on pipeline that they've built today. And so we only give them a 20% haircut in 2021. Okay. And then the haircut, as you see, kind of starts widening a little bit as you get it further and further out, ultimately building up to sort of the bogey of 100 million, right? So again, I'm on page 12, just sort of recapping, the management versus our sort of VC projections. What management sent us over, we dropped into our TAM to see how their revenue stacks up against our TAM calculations and what that implies in terms of a percent market share that they believe they could get to, which, they believe they could get 5%. Then again, based on our own diligence, we believe the business conservatively could get to around 100 million based on our research. Again, in venture, ideally, we're trying to get some asymmetric reward for the high risk that we take on when investing so early. But for the most part, it's always helpful to balance and weave in some conservatism into your model assumptions in order to paint sort of the most accurate picture of what could happen. And then ideally, what ends up happening in reality is the business just way outperforms any projections anyone had, and it just becomes a breakout unicorn and everyone becomes rich and happy. But again, that's something no one can really underwrite to or project with a high degree of confidence when looking at early stage businesses.
Alex, I have a quick question.
Go for it.
Just going, it is kind of like a more technical detail maybe, but back on page 11, just to make sure that I'm following, because I think I follow your logic, but when you're putting an input, would those be in those spaces that are highlighted, like the 0.09%, 0.12%, 0.15%, or how are you kind of inputting those kind of haircuts?
That's a great question. Thank you, Julia. Yes, those are my drivers. So I, just for the sake of this example, I just manually put in just random numbers. But typically what you would do is you would maybe find an industry report that says, hey, this is the market share of other solutions. You kind of know some research that you did of what the end state market share will be, and you just triangulate to kind of fill in those yellow cells. Again, it's really an art. This is where it gets really fuzzy. It's more of an art than a science. The core guiding principle I retained was, hey, we know that the business is an SMB focused business, so the majority of their market share should be an SMB, or the majority of the revenue should be coming from SMB market share. So again, it's truly just, not a shot in the dark per se, but it's a guesstimate, right? And so those numbers are just guesstimates that I put in based on what I think could happen. But it's a good question.
And the goal was kind of to have that 1% market share, like the 100 million instead of the 500 million, and then kind of putting in the drivers based on that, right?
Exactly. We have the bogey of, we believe this business can be $100 million business based on competitors in our research, and we're working backwards from that bogey, to kind of fill in these assumptions. So yeah, that's a good question. Thank you. Yeah. So shifting gears.
Another question real quick. It's kind of going back all the way to when you talked about the two methods, top down versus bottoms up.
Yep.
When you solve for which one to use when you're modeling? Is it dependent upon what stage the business is in? Because I think you alluded to, because we're focusing on early stage, maybe you'll use a top down versus bottoms up.
Totally. Yeah. I mean, it really depends, less so the designation of stage, more so how much data you have, right? If you have
Got it.
little to no data on a company, the best thing you can kind of do to guesstimate revenue is do some TAM sizing and
Right.
come up with and slap on hey, I think we can capture this much of the TAM. Bottoms up is really, if there's a lot of data there, then you can kind of do a bottoms up build. And we'll get to bottoms up in the back half. But yeah, it's less so about early versus late. It's more so about, do you have data or not?
Okay.
So this is
Got
for if we have, virtually no data. But cool, yeah, page 13 is sort of just a quick framework I pulled together on how to think about like returns. Because obviously, a model is helpful to sort of see how a business could be operating, but ultimately we want to see, how that translates into value for us as investors. So the returns analysis here, I encourage you guys to kind of just walk through it and try to think about it on your own time, but I'll kind of hit on the important stuff quickly. So I know there's a lot on this page, but the quick overview here is we built this kind of high level top down model of what we think is an accurate reflection of what could happen with the business. And now we're trying to figure out what that implies from a return standpoint. So this page just, again, has a framework for modeling out VC returns and a few key things you'll need to accurately model out returns are steady state revenue. So that's essentially the revenue, in the year that we're going to exit the business. And we're assuming a 2027 exit. So a 7-year investment hold. 2, you're going to need to know, a reasonable exit multiple. We can talk about that, how to figure that out. And then 3, you're going to want to have a sense for what your percent ownership is as a VC at exit, and how that percent ownership could be diluted down based on subsequent rounds of financing and whether or not your firm participates in those rounds or not. Obviously, if your firm just does a seed stage check and then the business goes on to raise 5 more rounds of funding, you might have had 20% ownership at the seed stage, but then by the Series F, you might only have 5% or less ownership given dilution, right? So the right-hand side of this page has a super simple cap table, just number of shares pre-financing and the number of shares post-financing. And here we're contemplating doing a Series A into this hypothetical business. And you can see from the cap table, we're going to be buying 6 million shares, and that gets us about 22% ownership post the Series A financing. So I'm not going to get into cap tables too much because that, again, can be its own whole section. And there's a ton of great resources online. But if there's enough interest, maybe we can do some cap table modeling on a different section or an entirely different session. But for now, I'm just showing kind of a high level view of a cap table. But obviously, for those of you who have been inside cap tables or seen outputs from Carta, that there's a lot of underlying detail that kind of builds up into this summary view. But anyways, below that cap table, we see I make some assumptions around future financing rounds. So and I kind of say, hey, maybe the business is going to raise around at this point, again at this point in time, or 2 years down the road, or 4 years down the road, what have you. And I kind of base that when they're going to need to raise another round based on their runway and their burn rate, which we'll hit on shortly. But and so then I kind of calculate what our percent ownership is. To do so, we just take the dollars that we invested divided by the post money valuation, where the post money is equal to the pre money plus the total dollars raised in that round. Right? Hopefully, you all have seen that equation before. And then ultimately, based on subsequent rounds of financing, in section 3, I kind of model out how diluted we get in each round. And then that kind of gets us a view of like what our ownership will be after Series C, right? So you can see that on the very bottom right-hand side, you see we entered the business at Series A, we got 22% ownership. We participated a little bit in, the the series B and the C, but obviously we made room for new investors, and so that dilutes us down from 22%. So when we exit after the Series C, our ownership gets diluted down to 19%. And if we hadn't participated, obviously the dilution impact would be much bigger. But anyways, so now let's look at the left-hand side and how we actually value a business at exit. And before, I kind of laid out some formulas up at the top. Why don't we look at those first? So to come up with the value of a business, the business is either going to be valued off of a revenue or EBITDA multiple. If it's faster growing and not profitable, you'll probably value it off revenue. And if it's profitable and slower growing, it'll be valued off of an EBITDA metric. And it also depends on how peer companies trade in the public markets. So in this example, we're going to value the business off of revenue because that's also the only thing we modeled. In our model, if you'll recall, we didn't really model down to EBITDA, which is just another fancy way of saying profit. So anyways, we take revenue times our exit multiple, and that kind of gets us our exit value. And then we take our exit value times our ownership in order to figure out how much cash we're going to get back as investors. So, for the sake of time, I'm going to kind of skip through, but you guys should go back and look at this. There's some helpful ways to think about laying out probability weighted analyses. So pages 14 through 16, I'm not going to hit on too much. Maybe you guys can just use them for further reading. The quick thing I'll say about page 14, which is comparable company analysis, this is how you come up with the range of exit values. So you kind of want to look at companies that are similar to the one you're evaluating and how they trade in the public markets. So hopefully some of you guys are familiar with comps and how to spread those or think about those. And then on 15 and 16, I have some examples of sensitivity analysis, which is just a way for us to sensitize a bunch of the core variables in our model, right? If you think about some of those core variables, maybe one of them is, percent market share, right? Our model has us exiting off of 1% market share, but maybe we want to look at what happens if we only get 0.5% market share, or if we get 2% market share, or 3%, or what have you. So we can sensitize and kind of see a range of outcomes using this type of analysis. And some screenshots are on page 16. And maybe we want to sensitize across some other core variables like exit multiple or amount of revenue, what have you. You can really sensitize by an infinite number of variables, so you can get really creative. But I would focus in on sort of what you think are the biggest drivers of value from returns. And then page 17 just has some other concepts. Again, there's a ton of detail in here, so I encourage you guys just to read this. Our model really just focused sort of on top line, like high level, what we need to believe to get revenue. But obviously below revenue, we have costs. And ultimately, something that's really important for early stage businesses is burn rate. So here I just have some quick thoughts on how to calculate burn rate, how you use burn rate to calculate runway. And then, runway is pretty much, hey, how much cash do we have in the bank today? How long is that going to last us? And if you're working with your portfolio companies, it's important to keep a close eye on cash and runway and burn because, if burn increases, your runway shortens and the business has a higher chance of going insolvent and running out of cash. So I encourage you guys to read that on your own. And it also has some thoughts on margins and unit economics and some other helpful stuff. So let's shift gears to what I find to be the fun stuff, which is the sort of late stage modeling. And here, I'm looking at page 19. We're going to focus on bottoms up modeling. So we hit on it a little bit earlier, but so we're going to build on a lot of the section or the concepts that we hit on the prior sections. But with the later stage business, we might have access to what's known as a data room, which is essentially a Dropbox or a Google Drive folder that just has a bunch of key files that an entrepreneur or management team might send us as part of their sort of financing round or process. And from those files, we can run certain analyses, and I'll hit on sort of which files trigger what analyses. And then ultimately, how you take those analyses and you bake them into driving your bottoms up assumptions So I have some really helpful examples in the deck, but again, at a high level, the simple mental model is now instead of projecting revenue based on some market size and slapping on a % market share, which obviously, as you all can imagine, isn't the most accurate way to project revenue by any stretch of the imagination. Now we're actually going to have some hard data, some really underlying business data that we can now use to inform a bottoms-up model where we can actually get revenue by saying, how many deals or how many customers did we win and at what price point. So now we can think about revenue in the equation of quantity times price. So let's keep moving forward. So this was a question we got ahead of time. How do you kind of start, and what do you do when you either get a data room or you get a model from management? The first thing I like to do, I typically like to just re-spread management's model into sort of my own format. Sometimes management's model is a little bit messy or can be have like a lot of noise in it, and so it's helpful to just respread the model into your own format so that anyone that looks at your model can quickly see what the core numbers are, revenue or ARR or gross margin, and they can look at annual trends and quarterly trends. So page 21 is, again, just a random hypothetical model from a random business. You can see they gave us this model on a monthly basis, and it's kind of just hard to read and kind of hard to pull out trends from like the screenshot that I have on page 20. So what I did is I kept all of management's numbers the same, and I just put them into my own format, again, so that I could make it more digestible and pull out trends and takeaways, and also craft some follow-up questions for the founder. So page 22 is a view of that. This looks like a lot, and I encourage you guys just to, like, on your own time, zoom in and just kind of look at each section. What I did is, instead of showing a monthly view of their projections, because that would go on for like 1,000 rows, or sorry, 1,000 columns in my Excel, and it's really hard to read and pull out key trends, I rolled those monthlies first into quarterlies. So that's what you see on the right-hand side. You see, the quarterlies. And then I rolled those quarterlies up into annuals on the left-hand side. And then I pulled out some growth rates and some composition metrics. So like how much each revenue segment accounts for total revenue. And then I, highlighted some key trends and with red boxes and put some questions in line into the model. You can write these questions in a Word doc. I like to just put it in line with the model. So if a partner decides to go into the model and look at it, maybe they can see, it kind of helps guide them on how to think through the business. But anyways, that's on page 22. Again, encourage you all to look at the differences between page 21 and page 22 just to see how it helps to kind of reformat a model that you get. And that's what I always do as the first step. And then in doing so, you also just get really familiar with how management built their projections, because you're kind of going through and relinking into your format. And then in your format, again, I can quickly see that some quick trends. In 2024, the business gets to, again, this business, hypothetical, it's getting to $540 million in revenue in 4 years. That's pretty aggressive, right? It's going from 1 million in 2020 to 540 million in 2024. So something we want to flag right off the bat and think about how we can maybe taper that assumption down. And we'll talk about how to do that in a bottoms-up way. And then I just pull out other kind of key margin trends throughout. But cool. Let's shift gears to page 24, just skipping over page 23 for a second. On page 24, again, you can see that I actually now reforecasted their revenue, and I show a comparison of my reforecasted revenue versus management's. And you can see that my reforecasted revenue has this business getting to north of 100 million in revenue by 2024, whereas management, again, was projecting north of 500 million. And so how did I get to this haircut, right? That is the real cool stuff that we're going to get into right now. Instead of haircutting market share, which is what we did in our top-down model, I'm actually going to look at what are known as productivity and efficiency metrics or ratios. and I'm going to readjust those to be more conservative and what I believe is a more accurate view, and then see what that kind of implies in terms of how much revenue the business can support. So quickly, just to define some of those productivity and efficiency metrics on page 25, shout out all my Office fans, but on page 25, I give a high level definition of what I mean when I'm talking about productivity and efficiency. Quickly, productivity is sort of just the quantity of work or dollars or revenue, that is produced by a team, a business, or individual. And productivity gains are essentially just how much more incremental revenue or production we can realistically expect from a unit or a person or an entire functional group, what have you. And then efficiency is very interrelated, but it's essentially the amount of resources required to produce that work. So obviously, the more time and resources and effort to produce that work, the less efficient one of these ratios could look like. And efficiency gains, again, is just how do we do less? How do we do more with less? How do we use less resources to still sustain that same level of production? Again, in our early stage model, we just haircut management's projections by bringing down percent market share, but that really gives us no insight into how that revenue was produced, who produced it, or how efficiently it was produced. So let's dive into that. Page 26 has my sort of productivity and efficiency metrics for how I projected that the business that we've been the hypothetical business we've been contemplating in this section of the presentation. I encourage you all to read it because I laid out enough information here for you guys to kind of read these bullets and follow along with the numbers above to ultimately see what I did to tweak down some productivity metrics. I'll quickly hit on it now, just some voiceover, but let's assume this hypothetical business sells hardware widgets. And those hardware widgets produce some stream of non-recurring hardware revenue, or NRR. And each widget sale is coupled with a software sale that sits on top of the hardware. And so that generates a subscription revenue stream that is recurring in nature. So we have some non-recurring hardware revenue, and associated with each hardware sale is some recurring hardware or some recurring software revenue. Okay, so it's a hardware software business with a subscription piece. Anyways, the rest of this page, I encourage you guys to read it, but I essentially just figured out how many widgets management thought that they could sell, and I worked backwards to figure out how much recurring revenue per widget they were generating and how much non-recurring hardware revenue per widget they were generating. So those are both productivity ratios. And in management's projections, they were assuming like, hey, today we're generating $24 of revenue per each widget sale. That's total revenue, accounting for hardware and software. But by 5 years out, we're going to be able to do like $1,000 of revenue per widget sale. That's obviously a massive uptick. And based on my expert calls, I felt that wasn't realistic and that there's going to be minimal pricing leverage or minimal sort of ceiling for them to kind of increase widget prices, so to speak. So I more conservatively modeled out that revenue per widget is going to go, and you can see it in the red box highlighted on page 26, is only going to 2x. So maybe today they're selling, they're getting $24 of revenue per each widget sale. By the out years, they're going to get $46. And then on top of that, I also slowed down the growth of how many widgets that they're actually selling. So you can see that in sort of the widget snowball, a little bit above that, where the widget snowball is the beginning amount of widgets, how many widgets they added or lost in a period, and then what you end with. I slowed down that middle row, the net adds, to kind of work backwards. And again, this was based less in assumption, based less in hard facts. I kind of knew, or I talked to my partner, and we kind of knew this business could get to 100 million, or that was our gut feeling. And so we tapered down the ASP drivers, the revenue per widget sort of productivity drivers that, like I discussed, and then I kind of just back solved to get net adds to a slow net ad growth so that by the end years, they're only selling, 2,500 widgets versus what management was projecting, which was 5,000 widgets. So anyways, you guys should look at this on your own. I want to hit on some other slides in here. So the next few pages are focused more just on SaaS businesses. Most of you all have seen or heard of SaaS. And so it's obviously, an ubiquitous thing across venture and tech investing. But really, the underpinnings of a subscription-based model are so common. There's just a lot of commonalities in this type of business model. So I've linked to some helpful articles and overviews that help kind of elucidate what those commonalities are. But it's also a really easy business model to sort of wrap your head around and understand how to project. So let's go to page 28. Here is another sort of bottoms-up revenue build. And so, maybe let's just talk about sort of the three revenue streams going in. This business has recurring revenue, which is, again, probably recurring revenue coming from the sale of a subscription license for the software. They have reoccurring transactional revenue. And reoccurring just means that there might be year over year the same volume of revenue, but there's no contract underpinning that revenue because maybe it's payments volume, or maybe it's GMV, gross merchandise value, times some take rate. And so, if I'm Stripe and my business is based on payments volume, I can't contractually obligate people to, funnel a bunch of payments volume through my platform every year. I just have to hope that year over year there's payments volume coming through. So it's revenue that's not underpinned by a contract. And then you have non-recurring revenue, which could be professional services, hardware sales, just anything that's a one-time sale. So ultimately, again, you guys should just look at sort of the definitions on the right and see how they kind of see the drivers on the left of how I project out each revenue stream and ultimately roll it up into this really nice little summary of the three revenue streams and total revenue. So I want to be mindful of time. I know we have 5 minutes. Page 29 shows the full projections, and it just builds on the left-hand side of 28. So look through this and just try to think through how everything links up on your own. Page 30 I won't spend too much time on, but it's essentially just kind of discussing the differences between bookings and revenue. So if you're unfamiliar with that nuance, page 30 and 31 have some helpful kind of context. And then if we shift gears to page 32, most of our chat today has been focused on revenue, but obviously that's not, the end all be all. We got to sometimes think about margins and costs. So maybe we have this really detailed bottoms up revenue build that we built on page 29, but maybe we want to build some costs in underneath that. So this page kind of just shows you how to think about forecasting costs. And I linked to this website called McAbacus, which I encourage everyone to go to and kind of click through their tutorials on how to forecast, because they have phenomenal tutorials. It's honestly how I learned 95% of what I know about modeling through that one website. So yeah, I encourage you guys to look at that and just kind of, on the right-hand side here, I included some thoughts on best ways to kind of project out costs. I guess maybe what's really relevant is to look at operating expenses. So general and administrative, research and development, S&M. And on the bottom, I kind of wrote out some ways I like to project those out, either as a percent of revenue or using a year over year growth rate or a percent of total bookings. And so page 33 is that initial widgets business that we talked about earlier. And at the bottom here, I show some efficiency metrics, right? Like rent per head or cost per head for salaries. And I just use those efficiency metrics to more accurately reflect costs in the business. Initially, management's model had efficiency metrics kind of dropping off a cliff. So they were assuming today they could pay 77,000 per head. And then they were assuming by the out years, they were only paying like 20,000 per head. So clearly, it's more likely that salaries are going to increase over time. So that's kind of what that I show here. And I kind of went through that same kind of logic and rationale for each expense line in this hypothetical widget business. I know we're on time, but page 34 has some other, these are kind of data items you might see in a data room or stuff that you might want to ask an entrepreneur for. I encourage you guys to read this. It's pretty thorough. And then page 35 has some other advanced modeling topics that obviously we didn't hit on today. Most of what we talked about today was like really just core operational modeling, focusing mainly on like what goes into revenue, how you can think about the costs that sit underneath revenue and build down to core profitability or EBITDA. But again, there's a lot more complexity that you can encounter. Like we didn't really talk about 3-statement models, which we just mainly focused on the income statement piece, but there's also a balance sheet and a cash flow and statement, which you might not have to encounter in VC. But if you're doing a really late stage deal that has, in the business model, maybe involves the balance sheet a lot, you might have to think about modeling out some select balance sheet items. So anyways, these are just other topics, and there's tons of resources online too. But I know we're truly up on time. I can stay on for a little longer and answer questions because I know that was a lot to cover. And again, this deck hopefully serves as a good reference that, if you're looking at a late stage business or a company with a lot of data, hopefully you can reference some of these pages to help guide you on questions to ask, data to ask for, maybe some analyses you can run off of that data, and ultimately how you can package all of that up into a model. So I will pass it back to Abhinaya or Heloise if you guys have questions that you kind of collected from the audience. We can hit on those.
Yeah, thanks, Alex. We'll be here for a couple more minutes, kind of going through the questions. Just so you know, if you have to drop off, there will be a recording and the deck will be shared again. Maybe I'll edit the video a little bit so the deck and the video can be in the same place. And just a heads up that we have 2 more sessions coming up in the next 2 weeks. We have one next week on Thursday and another 2 weeks from now on Wednesday. And the registration links will be in an email that we'll follow up, and also on the Slack channel. So now we'll kind of go through some of the questions that we've been gathering, Alex. The first question is, will you be able to provide the Excel template for future reference or future usage?
Yes, let me just clean it up a little bit and make it more intuitive. But yeah, I can pull together sort of some of the Excel templates and so that you guys can actually click through all the cells and see the formula. So yeah, let me clean those up and I'll share them with everyone.
Perfect. What are some red flags that you should look for in a data room?
Sure. So before even getting into the red flags, when you get a data room, you might have a ton of files in there and it can be a little overwhelming. It's always helpful to take a step back and think about what your investment thesis is and what analyses you kind of need to do to help validate the key points of your thesis. Maybe one of the thesis items is, hey, we think bookings can double, for the next couple of years. So maybe, the 2 analyses to support that would be looking at pipeline data and then looking at, the customer database or customer by revenue database and seeing historically how much bookings the business has produced in the past and how much they can do, going forward. And again, if it's an early stage business that is pre-product market fit, they might be going through a lot of pivots. And so, historical numbers might not be the most accurate reflection of the future, in which case you should really, look at pipeline to help answer that question. But anyways, the red flags in the data room, as you're kind of going through files, if you have a customer database and you see, and for everyone that hasn't seen a customer database, that is like the holy grail file. If there's only one file you were going to get from a company, it should be this file. It essentially lists out all of the company's customers on the left-hand side, and then their revenue per customer over time. And from that, you can do retention and churn analysis. Like I said, you can figure out what bookings were each year. You can figure out how many new customers joined, how many customers left, how many dollars left. So there's really a lot you can do with that, but red flags within that file. if there is really high churn, so you have a leaky bucket, meaning, hey, maybe every year we're churning through 50% of our dollars or 50% of our customers. Over time, like if growth slows down and you have really high churn, your churn is going to eat away at your customer base and your revenue base to the point where the business kind of just dissolves. So you really want to keep an eye out for that kind of stuff, churn, retention. Additionally, from that customer database, you can figure out who the biggest customers are. One thing you really want to keep an eye out for is customer concentration. I think I read a study somewhere that the big, like there's a million things that can go wrong with any business, but the biggest thing that goes wrong for across most businesses, not just in tech, but across all industries, is they just had too much customer concentration. And for whatever reason, that customer could go out of business and then you lose a good chunk of your revenue. Or that customer could go to another solution. Again, that's dollars leaving out the door. So look for low retention, high churn, that's red flag. Look for high customer concentration. If there's 100 customers and maybe 2 of those customers represent 50% of your revenue, that's a big red flag. You're going to want to go talk to those customers as part of your diligence to understand, to really make sure that they're going to be sticking with the business. And then you're also going to want to dig in on how management's thinking about diversifying the rest of their customer base. Those are the biggest red flags. Anything, again, like maybe bookings growth is slowing. You can get a sense for that from the customer database. So if bookings growth has slowed, like maybe unpacking why, and if you think, bookings can kind of pick back up. So any negative growth rates, again, big red flags.
Got it. Next question. How do you translate gut feelings or anecdotal knowledge into a financial model without compromising the quantitative research-driven model?
Yeah, it's a really great question. Modeling, again, is, ideally you can make it more science than art. But again, if you're working with a limited set of information, there's going to be times where some assumptions are kind of based on your gut. Ideally, what you can do is simplify the model to remove those gut assumptions and really just have the driving assumptions be what you know to be cold hard facts. But if you really must kind of drive something off a gut assumption, kind of like what we did, what I showed in the top-down model, where we drove revenue off of like what we believed could be market share. That wasn't just a total, gut shot in the dark. It was influenced or informed by expert conversations we might have had, as well as industry reports that we read, and also maybe again we looked at similar competitors that are already scaled businesses and how big they are, and so we kind of triangulated our gut feeling around some soft data points. So ideally, if you're going to put a gut assumption in there, it has some data points to validate it. But for the most part, if you can avoid truly just random assumptions, definitely keep those out of your model and out of your analyses as well.
Thanks, Alex. 2 more questions left. The next one is, do you also use a DCF analysis in conjunction with your comps analysis to get a valuation?
Yeah, it's a great question. Typically, when you're trying to triangulate valuation, there's a lot of ways to do it. If you guys have ever heard of a concept called a football field, I would encourage you to Google it, a football valuation field. You can essentially, there's not one right way to get to that terminal exit value. Comps are just one tool. A DCF, which stands for discounted cash flow, is another tool. You ideally would want to take multiple valuation methodologies, whether it's public trading comps, precedent M&A transaction comps, a DCF, and maybe see what value each of those analyses or each of those valuation methodologies spits out. And then you can kind of triangulate or take the average of all 3. So you could use a DCF. I personally don't, because again, a DCF hinges on your ability to model down to cash flow. And with an early stage business, almost impossible to know how much cash that business is going to generate. And so you kind of end up in a situation where you're just going to be like really building in a ton of gut assumptions. And so that's why I kind of lean almost exclusively on comps when thinking about what is that terminal exit value versus a discounted cash flow valuation, which again, it's just really tough to project out cash flow. Again, we're minority investors in these businesses and we don't own or operate them. So we can't determine how they're going to reinvest their cash. We can't really determine if they might take on any debt. So we have no idea, what their cash position will be and how much cash flow they'll be generating. So the DCF is in many ways, it's a helpful tool for much later stage businesses where you have that level of visibility. Like I'm talking like Series C, D, E, but for anything pre-Series C, it's really hard to use a DCF.
That makes sense. Thank you, Alex. Last question is about early stage modeling. So how many years of detailed revenue projection would you expect from a pre-seed company that's seeking seed funding?
Yeah, sure. I think what is more important is just their near-term projections. Like if they send you a 10-year model, like probably years 2 through 10 are not going to play out that way. Like I can almost assure you 99% of the time that will be the case. So it's important if you get a model from a pre-seed business, don't worry about sort of those late out year projections. Really focus on years 1 and 2. How much revenue are they going to get next year? How are they going to get that revenue? What kind of data or underlying data, again, look at pipeline, helps us get confidence in their ability to hit revenue plan. And so, yeah, again, anything past years 1 or 2 is going to be super fuzzy. If you really want to look at the out years, that could be helpful for understanding, again, hey, if management believes this is going to be a $300 million business, what could that imply for our returns? Like if management hits this case, like this is how, it could be a 10x business or a 10x return. So the out years you can maybe just look at them to get a sense for if all goes well, this is how much money we can return back to our VC firm. But early years are the most important when kind of doing diligence.
That's fair. Thank you so much. That's all the questions. Really appreciate you having you here, Alex. That was really helpful. I think that's it. Have a nice day, everyone, and looking forward to speaking to everyone next week.
Thank you, everyone. And
Thank
feel free
you.
to shoot me an email. I left my email in there if you guys have any more questions.
Thank you.
All right.
Thanks, Alex.
Very welcome. Bye, everyone.
Bye.